Let's do some research. I just went through the ASX 200 to find all of the companies that fit my dividend investing criteria, and out of 200 companies, only 5 fit my criteria. Goodness gracious me. So let's jump into the research, have a look at which companies within the ASX 200 fit my dividend investing criteria. Let's go. Let's get the list of 200 companies first so I can put them in my spreadsheet. I'm going to get it from Market Index this time for something different. Now I just copy and pasted this, so I don't need all of the rest of the columns. I only want the code and the company, so I'm going to delete everything else. And let's choose a nice font. Okay, so the first step, as you know, is always to narrow down by dividend yield. I prefer a dividend yield of 5% or higher. I will go lower than that sometimes depending on the company, but for this exercise we're just going to stick to 5%. Since I'm already at Market Index, I might as well just get the dividend yield from here. A2 Milk doesn't have dividends, so we'll put 0 there for that one. And I will go and fill in the rest of this information. Filling in the dividend yield for those 200 companies took me about 40 minutes, not too long. It'll probably take me even less to do the rest of the research, so yay. Now that I've sorted by dividend yield from highest to lowest, we can get rid of everything that's under 5%. So we've narrowed it down to only those that have a dividend yield over 5%, but that's not the final step because we need a lot more information. We need stability, we need to make sure that the company is growing, and a lot of other factors that I look for. So let's go into the next step, and that is finding out if the dividends are stable and growing. Now, if the dividends have been decreasing over the last few years, that's a no. If they've been stable, that's a yes. And if they've been growing, that's also a yes. So let's have a look at these companies and see which ones their dividends are growing. Since we're at Market Index, we might as well just stay here and go down and have a look at the companies one by one, those that already have a high dividend yield, and see if the company dividends are growing or not. Sometimes if they're growing overall, but in 2020 they dipped a bit, I'll allow that since a lot of companies did defer their dividends during that year. Looks like Stockland is decreasing their dividends, so that's a no. Genesis Energy looks nice and stable. Now let's sort this list, and I'll remove all of the no's for those that the dividends are not growing or are not stable. Okay, we've got 16 left. Let's now go through the 5-year returns and see if we can cut this list even further. The next step is to look at whether the company is growing over time. I like to look at a timeline of 5 years or more, and if they've gone up by at least 50% growth over the last 5 years, that's a win in my books. Sometimes I'll go lower than 50%, but generally that's what I'm looking for. The reason being, although I primarily invest for the income, for the dividends, I also want growth. I also want the company to increase the value over time. Fortescue, nice and high after 5 years, as most of the materials companies will be. Here's an example. Horizon is decreasing over the last 5 years, and we don't want that because we want growth as well as dividends. So that is a no. Okay, got my list. Let's sort by yearly return, and we'll delete anything under about 50% over the last 5 years. That just leaves us with 4 minerals companies and 1 retail company. Now, I would imagine that the debt to equity on these 3 companies is fine, but let's go and grab those figures anyway. Now, we've narrowed it down so much from our original 200, and we've only got 5 left. The last step I look at is debt to equity. Now, I'm usually looking for something that's got a debt to equity less than 80%. Now, if the company does get into trouble, oftentimes the first thing that they'll start to cut is the dividend so that they can keep their cash flow going to pay their loans and so on. You don't want any sort of chance that the dividends might be cut or stopped if the company gets into trouble, like if we go through a pandemic. So that's the reason I like to keep the debt low on companies that I invest in, simply because I want that income to keep coming in, so I'm getting that monthly dividend income. Yep, as I thought, the debt to equity on these companies is fine. So we can then now go ahead and say, there's our list for December. These 5 companies: Mineral Resources, Fortescue Metals, JB Hi-Fi, BHP, and Rio Tinto. So there you go, 5 companies from the ASX 200 that fit my investing criteria. Only 5 out of the 200. I thought there would be more. But you just never know when you do the research. Have a happy Christmas. Bye.